Inflation just printed its hottest reading in over 2 years, and it landed as something worse than hot. It landed as stuck. The headline ran to 4.2%, a third straight monthly acceleration, driven by an energy shock from the war with Iran. The core, the number the Federal Reserve steers by, did cool. But hot, accelerating, supply-driven inflation against a slowing economy is the one combination a central bank cannot ease into. The Federal Reserve's rescue just came off the table. So the crowd kept chasing the same thing it always chases. The largest public offering in history prices this week into a market where a single handful of artificial intelligence names are doing all the work. $75 billion of supply pulled out of an already narrow tape. Everyone is crowding the top. But the real signal was somewhere almost nobody was looking. The bellwether of the entire build, the largest American copper producer, is cutting its own output by nearly a quarter into the steepest demand surge the metal has ever seen. The edge isn't in the crowd. It's in the one thing the whole build runs on and can't make fast enough. This is the asymmetric. Issue 12, the bottleneck, tech and crypto investing for thoughtful retail from an operator's lens. On verdict day, the most important inflation print of the quarter didn't resolve the rate trade, it closed the easing door. And the durable edge moved to the one constraint that doesn't need the Federal Reserve to ease. Here's the one-line read. The verdict came in stuck, so the edge moved to the constraint. May inflation ran to 4.2% year-on-year, the hottest since 2023, a third straight acceleration on a 23% jump in energy from the Iran shock. The core cooled, but against softening growth, the market reads stagflation, not relief, and that boxes the Federal Reserve in, 1 week before its first meeting under Kevin Warsh. Gold held firm on the stagflation bid. Bitcoin sank to a 19-month low on a record outflow, even as large holders pulled coins off exchanges into custody. Underneath it, the durable signal was physical. The bellwether copper producer is cutting output about a quarter into the steepest demand surge the metal has ever faced. The same discipline labels run throughout: confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. This is research, not advice. Part 1, the verdict, a boxed-in Federal Reserve and the constraint underneath. The verdict at a glance: headline inflation at 4.2%, the hottest since 2023 and a third straight acceleration over a core that cooled, but with a stagflation tint. A December rate hike still priced near even money, gold firm on the stagflation bid. Bitcoin near a 19-month low, but with large holders accumulating. And Warsh's first meeting, June 16th and 17th. Boxed in, he cannot cut into a 4.2% print. No clean answer, so the edge migrates to the trade that pays whichever way the tape breaks. Start with rates, a hot, accelerating print that boxes the Federal Reserve in. Headline inflation ran 4.2% year-on-year, the hottest since 2023, a third straight monthly acceleration, energy up over 23%, more than 60% of the increase, as the Iran premium hit the data. The core did cool, 0.2% on the month, below forecast, but the direction and the driver, a third acceleration. From a supply-side energy shock against softening growth is a stagflation tint, and it's the one combination a central bank can't ease into. The market still prices the next move as a hike near even money for December, and it hands Kevin Warsh a 4.2% headline 1 week before his first meeting. Then the structure of the market: a thin tape and a renewed wobble in the most crowded names. Only a handful of stocks sit at new highs even as the index made them, with volatility rising alongside the market, a classic pre-correction tell. Strip out the artificial intelligence cohort and the broad market is roughly flat. On verdict day, equities slipped, the S&P down about 0.4%, with energy the only leadership as tech. Industrials and discretionary dragged. A narrow tape derating its leaders into a hawkish Fed and a record-offering wave has little margin for error. Into that tape lands the largest public offering in history. SpaceX prices Thursday night and trades Friday, about $75 billion raised at a valuation near $1.8 trillion, which would make it the 7th largest company in America. The book is heavily oversubscribed, and a prediction market puts the odds it closes above $2 trillion, near 63%, a textbook hero IPO setup, which is exactly when the supply matters most. And the wave's demand leg is live. Anthropic just shipped a new state-of-the-art model days before its own IPO. By some estimates, $4.5 trillion of offerings are queued for this summer, against roughly $1.5 trillion in all of American history. A primary deal pulls cash out of the secondary market, the drain shows up as price. Now the havens, and here's the tell of the day, they diverged. Gold held firm near $41.50, structurally elevated on the safe haven and stagflation bid. A 4.2% accelerating headline with a war premium is exactly the regime gold is built for. Bitcoin went the other way. It sank to about 61,700, a 19-month low, down 17% on the week. On a record $3.4 billion outflow from the exchange-traded funds. But underneath the price, the flow diverged. Large blocks, 800 coins at a time, moved off an exchange into custody. Capitulation in price, accumulation in flows. Gold is trading as the macro hedge the regime rewards. Bitcoin, as a high beta proxy being used as a funding source, with whales accumulating into the flush. Put it together, the verdict didn't split the difference, it closed the easing door. A hot, accelerating, energy-driven headline against softening growth boxes a hawkish new chair in 1 week before his first meeting. A record offering drains a narrow tape, 2 geopolitical flashpoints sit under the energy bid, and the havens diverged, gold firm on stagflation, Bitcoin capitulating on price but accumulating in flows. Underneath it, the durable signal was physical, a supply constraint hardening into the steepest demand surge copper has ever faced. The message, less duration, less leverage, plus the one input layer the whole build is gated on. Part 2, in focus, the metal the whole build runs on, the data, then the debate. The lead is Freeport-McMoRan, the largest American copper producer, the bottleneck, in one balance sheet. In the first quarter, copper production fell about 24% year-on-year to £662 million, and Freeport still beat because the realized price jumped to $5.78 a pound from $4.44. Revenue of $6.2 billion, net income of $881 million, earnings beating consensus by about a fifth. The bull case is price over volume. Supply is being revised down. The company cut guidance at Grasberg, the world's second-largest copper mine, into the steepest demand revision up in the metal's history. A single large artificial intelligence data center can need up to 50,000 tons of copper. The International Energy Agency has mines meeting only about 70% of projected 2035 demand, and permitting runs 15 to 17 years. The bear case, copper is cyclical, and a hard landing can bite the price before it rewards the secular thesis. The cleanest, lowest correlation way to own the build-out's binding constraint, where the entry, not the thesis, is the hard part. In crypto, the headline is a divergence, capitulation in price, accumulation in flows. The exchange-traded funds saw a record $3.4 billion outflow in a single week, the largest since they launched. Bitcoin sank to a 19-month low, deeply oversold. But the flow under the price went the other way. Large blocks, around 800 coins each, moved off an institutional exchange into custody, which reads as accumulation. Not sell pressure. The weak hands are being flushed to stronger ones. The contrarian frame, worth watching, not chasing. If that churn is happening now, Bitcoin could be the most under-owned asset when the cycle turns. And the thematic read, artificial intelligence has turned capital heavy, and copper is its tax. And the demand is accelerating, not slowing. Anthropic just shipped a new state-of-the-art model ahead of its IPO, and more capability pulls more compute, more power, more copper. Who collects the tax? The unglamorous input and infrastructure layer the data centers run on, copper and critical minerals producers, power, electrical equipment, low-cost gas. Who pays it? The capital-heavy names tapping equity to fund their build. An $84 billion equity race in June alone, each raise a drain on the same narrow names. The capital-light tech miracle era is over. The bill of materials is the gating item. Part 3, the bottleneck signal, a boxed-in Federal Reserve and the edge in the physical layer. The print closed the easing door, don't trade the cooler core as a dovish signal. Oracle borrows to grow, the producer gets paid by the build. The copper bottleneck is the new lower correlation axis. Freeport proved it, an output cut into a price jump, with the second largest mine guided down. And SpaceX is the offering trade's demand test, where the edge stays, optionality, plus the constraint. What we are watching the next 10 days, Oracle's earnings after the close, the debt-funded artificial intelligence cash flow test, SpaceX prices Thursday and trades Friday, the Federal Reserve and Warsh's first press conference, now boxed in by a 4.2% headline, Anthropic's new state-of-the-art model and its coming IPO, a copper review at month-end, two geopolitical flashpoints, the Strait of Hormuz, and Taiwan firing rockets toward China-facing waters for the first time, and whether Bitcoin's record outflows reverse or the whales keep accumulating. And we keep score in public. Freeport, the copper bottleneck bellwether, Palo Alto, a quality compounder patient on entry, Oracle, watch the print, Bitcoin, a capitulation tape entry sensitive, Alphabet and Amazon, attractive patient, gold, constructive on the reserve bid, EQT and Cigna, still attractive, each is a dated, falsifiable call, and we grade them. So where does it land? 3 takeaways. The print boxed the Federal Reserve in a hot, accelerating headline against softening growth is a stagflation tint that takes the rescue off the table. The durable edge moved to the physical constraint. The bellwether is cutting copper output into the steepest demand surge the metal has ever faced, and the demand side just hardened with Anthropic shipping a new state-of-the-art model ahead of its IPO. And the liquidity drain is mechanical, pricing this week as the largest offering in history meets a narrow tape. The edge is optionality plus the constraint. That's the bottleneck. The asymmetric turns filings, flows, and market data into one disciplined read for investors who want the evidence, not the noise. This is research, not personalized advice. Verify it yourself. The Federal Reserve's door closed. The bottleneck did not. We'll see you in the next issue.